The global financial system can feel like this massive, impenetrable black box, right? It's just full of confusing jargon and trades that seem totally mysterious. But really, at its core, it's all about solving problems. So today, we're going to pry open that toolbox, the one used by the world's biggest financial players to manage their absolute biggest risks. Okay, let's get into it. On the surface, you'd think not much. One's holding your savings, another one is a promise to pay out if something terrible happens, and the third is out there making these huge, high-stakes bets on the market. They seem to have totally different jobs in our economy. But behind the curtain, they all share a fascinating little secret. That's the key. They all rely on this really sophisticated set of tools. You'll often hear them called derivatives, that are provided by the global markets divisions of the big investment banks. And these things aren't just for gambling. They're more like surgical instruments, each one designed to solve a very specific business problem. Understanding them is really understanding how modern finance actually works.
So here's our game plan for this explainer. First, we'll look at the big, hairy problem that pretty much everyone's trying to solve. Then we'll break down how banks, insurers, and different kinds of funds use this toolkit for their own unique challenges. And finally, we'll wrap it all up with the one big idea you should take away from all this. So what is that one huge problem that keeps Wall Street awake at night? Well, it all comes down to managing massive, totally unpredictable financial risks. We're talking about the kind of chaos that gets unleashed when interest rates suddenly go haywire, or that domino effect when the credit cycle shifts and loans that looked safe yesterday suddenly don't. These are the kinds of forces that can shake even the biggest players to their core.
Let's try to translate some of this banker speak into plain English. When you hear balance sheet vulnerabilities, what they're really worried about is just unexpected financial surprises that could blow a hole in their business. Shifting credit cycle? That's just a fancy way of saying they're afraid a whole bunch of people are about to stop paying back their loans. And regulatory capital constraints? That just means the rules say they need a bigger safety cushion, which ties up a lot of their money. See? They're real-world problems, just on a mind-boggling scale.
All right, let's kick things off with banks. For them, it really boils down to two main objectives. First, protect their earnings from going on a roller coaster ride. And second, manage their capital, that safety cushion we talked about, as efficiently as possible. So this is the bread and butter of banking, right? They make money on that little gap, the spread, between the interest they bring in from loans and the interest they have to pay out to you on your deposits. But what happens if they've written millions of 30-year fixed-rate mortgages and suddenly the rates they have to pay for deposits just shoot through the roof? Well, that spread can shrink to nothing, or worse, go negative. This volatility in their net interest margin, or NIM, is a huge, huge threat.
So how do they deal with that? Well, this is where the interest rate swap comes in. It's a pretty elegant solution, really. It's just an agreement to trade interest payments. The bank can take all that fixed income from its mortgages and swap it for a floating income stream. Now, its income moves up and down, right alongside its deposit costs, and that precious profit margin is protected. It's all about creating some predictability in a world that is anything but. And just to be clear, this is not some obscure strategy. When interest rate volatility really exploded after 2022, the use of these tools just went ballistic. The trading volume in euro interest rate derivatives in 2023 was nearly 3.5 times what it was back in 2020. That just shows you how absolutely essential these tools have become.
Okay, so problem number 2 for the banks is all about capital. For every single loan a bank makes, regulators force them to lock away a chunk of their own money as a buffer, just in case that loan goes bad. This is what's known as risk-weighted assets, or RWA. The problem is, the more loans they make, the more of their capital gets tied up, and that leaves less money available to make new loans and, grow their business.
The solution here is one of the coolest tools in modern banking, the significant risk transfer, or SRT. It's pretty much what it sounds like. A bank goes out and buys what is essentially an insurance policy on a piece of its loan portfolio from investors, think hedge funds or private credit funds. By offloading a slice of that risk, the regulators give them the green light to shrink the size of that capital safety cushion they have to hold. Let's just walk through a quick example to see how powerful this is. Say a bank has a €5 billion loan portfolio. That is tying up a ton of capital. So it goes out, finds an investor, and buys protection on what's called the mezzanine slice of risk. Not the safest part, not the riskiest, but the bit in the middle. And the result? It's incredible. The bank instantly frees up €500 million in capital. That's $500 million that can now go straight back into the economy as new mortgages or loans for small businesses. Okay, let's switch gears and talk about insurers. You see, if banks are worried about what might happen in the next few years,
Insurers are thinking about the next 50. Their whole business is built on making promises today that they might not have to pay out on for generations.
And that creates their main challenge, something called asset liability management, or ALM. Think about it. An insurer takes your premium money today and invests it, but they have to be absolutely certain that those investments will spin off enough cash at exactly the right time to pay claims that could be 30, 40, even 50 years down the road. Even a tiny miscalculation or a long period of low interest rates could be a complete disaster.
So, naturally, their tools have to match that crazy long timeline. They use incredibly long-dated interest rate swaps. I mean, we're talking 30 years or even longer, to lock in reliable, fixed streams of income that perfectly mirror their long-term promises. And then they often add another layer of safety with something called swaptions. These are basically options on swaps, which is kind of like buying insurance on their insurance. It protects them from those extreme, once-in-a-lifetime events where rates could collapse and the value of their future promises could just explode. And in some places, like the UK, the regulations actually encourage this. There's a rule called the matching adjustment that basically gives insurers a capital discount for investing in long-term things that are hard to sell, like infrastructure projects. Now, that's great for the economy, but it creates a lot of risk for the insurer. So what do? They use these derivative tools to perfectly hedge all the currency and interest rate risks that come with it, and that makes the whole thing work.
And finally, let's talk about the wide world of funds. I mean, everything from the simple mutual fund that might be in your retirement account all the way to those super secretive hedge funds, they all use derivatives for one main reason: to operate like a hyper-efficient machine. And this table here gives you a really nice snapshot of how different funds solve different problems. Take a traditional asset manager. Their big worry is cash drag, which is just money sitting on the sidelines earning nothing. So they use futures to get that cash invested instantly. A private credit fund needs financing to make loans, so they use a tool we'll talk about in a second called a total return swap. And a hedge fund? Well, they want to make massive leveraged bets, so they use the entire smorgasbord of tools offered by a bank's prime brokerage. Let's zoom in on that total return swap, or TRS, because it is a total game changer. That analogy of renting an asset's performance, it's perfect. A fund can get all the economic upside of an asset, all the income it generates, any increase in its price, without all the cost and hassle of actually buying and holding it. They just pay a financing fee to a bank. It's an incredibly powerful way for funds to get leverage and access to markets with amazing capital efficiency.
Okay, wow, we have covered a lot of ground. We've looked at the big problems and the very clever solutions used by banks, insurers, and funds. So let's step back. What's the big picture here? Why does any of this hidden financial world matter to you?
So let's just tie it all together. For every one of these big players, these complex-sounding tools serve a really vital practical purpose. Banks use them to make their business more stable and to free up capital to lend into the economy. Insurers use them to make sure they can keep promises made decades ago. The asset manager handling your retirement fund uses them for efficiency, making sure your money is always working for you. And hedge funds use them to finance their strategies and chase returns. When you get right down to it, these aren't just abstract numbers on a trader's screen. They are the essential and mostly invisible plumbing of our entire financial system. These are the pipes and valves that allow risk to be shifted from those who can't afford it to those who are paid to manage it. They let capital flow to where it's needed most, and they provide the underlying stability that lets the whole economy function and hopefully grow. But all of this efficiency does raise one last really big question. These tools are fantastic for creating stability for an individual company. But what happens when everybody, the banks, the insurers, the funds, all start using the exact same playbook to solve the exact same problems? Does that make the whole system stronger and more resilient? Or does it just create a new hidden kind of risk where everyone is so tightly interconnected that one little crack could cause the whole machine to come crashing down? Now that is something to think about.